Hi, I'd like to welcome everybody to the latest Denny Artachi podcast. I have to apologize. It's been probably a month or so since my last podcast. I've been traveling, working on some things, and today I thought it was interesting to. I did an interview with Peter Nielsen, who's a chartered financial analyst with Independent Solutions. Peter is an unbelievable. His experience, he has over 30 years working with institutional investors, pension funds, mutual funds, high net worth individuals. And I had to edit it because, he's at such a high level. I wanted to have the message to normal investors that are out there. And I think most economists right now are predicting a soft landing in 2023. They don't see that inflation is going to continue the way it is. Peter definitely sees a lot of opportunity in this interest rate market, as I do. I mean, if you look at the fact that you can buy fixed rates, yielding 3.6% for 2 years, and I think I saw a 3-year fixed rate of 4.30 or something to that effect. That a couple of years ago, that would have been unheard of, even as recently as a year ago. But he thinks there's a lot of opportunity in the market. Peter manages different portfolios for Independent Solutions, and he has a Master of Business from the degree of Simon Fraser University, a Bachelor of Business from Trinity Western University. He sits on a board of Chartered Financial Analysts Society for South Carolina. I mean, I could keep reading his accolades, and he's also an adjunct professor of finance at Anderson University. But we were talking about rates and how things are. And again, I think the consensus is that we should see a soft landing in 2023, but there's certainly some opportunities. So I had to edit it back and forth because when he started going into some of his charts and the micros, he even lost me. But he's a great resource. He has different portfolios with Independent Solutions. He manages a momentum portfolio, which is pretty interesting because it generally uses low-cost ETFs and those type of vehicles that generate momentum. And typically, as something falls out of favor, they get out of the positions and go into cash. This is just one of the things that he does. He partners up with Paul Meeks as well. They have equity income portfolios and preferred dividend types of investments. But anyway, enough of that. I hope you enjoy it and listen carefully because Peter definitely has a lot to share. And here he is, Peter Nielsen, ladies and gentlemen. Tolerance. Do you see the stock market continuing to go down? Do you see it leveling off? And what do you think? This is a lot to go on for next year because we obviously have a midterm election, which could affect a lot of things. I think if we see some flipping of the House and possibly the Senate, we may have gridlock, in which case nothing will be solved for the next 2 years, which is typically good for stock markets. But what do you see both the equities market, monetary policy, GDP growth, and the overall economy from now until next year?
Okay, well, that's a lot. But look, this year, early in the year, it was made very apparent, and it made a lot of headlines how interest rate sensitive the stock market was. Interest rates, treasury yields would go up, the stock market would go down. And what we did early in the year, or around mid-year, is we regressed interest rates to S&P 500 levels, and the relationship was actually amazingly strong. So you could actually get a pretty good indication of where the S&P 500 was just by looking at the level of interest rates. And we actually had, if you remember, from about mid-June through to the end of July, we actually had a stock market rally. And that was coincident with a decline in interest rates as investors were kind of getting ahead of their skis, as far as their expectations for declining inflation. And now, of course, that's reversed course, and markets have now then again declined. We're still about 5% above where we were at the mid-June low, but interest rates are just higher, and all things being equal, if interest rates continue to climb, we would expect, based on that relationship that we mapped out, we would expect further declines in stock markets. That's what the data is showing us. As far as Fed policy, like I say, it's easy to talk brave when you have a super hot labor market, inflation's super high, and you're still expecting a soft landing in 2023. Now, it's a different story when we fast forward a few months as far as what the Fed messages, because if the labor market starts to struggle and inflation's falling, well, number one, falling inflation mitigates the need for super, heavy-handed Fed policy. It just does. The Fed is primarily concerned about inflation. Consensus estimates have inflation falling close to 2% by the end of the year next year. We model something similar, but we realize there's a lot of risk to our model. There's just a lot of stuff you don't know. It's hard to.
There was speculation early on that Feds would be very tight. They'd be raising rates and possibly lower them next year as the economy did cool off. And you're right. And people seem to forget that the market doesn't trade for the now. It trades for what they anticipate 12 to 18 months down the road and so forth. So, yes, guessing what the Fed's going to do is like, I don't know, going to Vegas sometimes.
Yeah.
But the consensus was that Feds could actually lower rates next year as we see some cooling. So the consensus on the street is that maybe we'll see a 2% cooling off from where we are now by the first quarter of next year.
Well, so if you're looking at consensus estimates and Fed funds futures, the futures market is expecting the Fed to get to 4.75 and keep it there for most of the year before cutting rates slightly towards the end of the year. But so that's not very encouraging. But the interesting thing is when you look at the implied probabilities of all those moves, there's a lot of conviction for the next 3 Fed meetings. After that, the probabilities fall off a cliff. So they're very low. And so there's not a lot of conviction in the fixed income markets about what's going to happen beyond the next 3 months.
Well, obviously, if we see inflation dropping, that'll be great.
Yeah, and that's important for listeners to recognize. So here we have a 20-year treasury. In theory, there's a market expectation for this should have the estimated annual inflation rate over the next 20 years. So near term is high, long term is low, but there's an inflation premium in there. If inflation premiums are falling, just inflation premiums alone, we would expect these yields to fall. And that implies that long-term bond investors would get like a capital gain essentially along the way as those bonds appreciate in price. So we think some of the risks to fixed income investors are actually mitigated because of the environment we're in. We're in a falling inflation environment, and given that it seems like that's playing out, it does mitigate the risk to fixed income investors to some degree.
But I guess we're all expecting a soft landing sometime next year. We're all expecting inflation to cool off, or at least we're hoping.
Yeah,
we're hoping for monetary policy to be eased.
Yeah,
and some kind of recovery in the equities market. I think that's what we're all hoping for.
Yeah.
Whether or not it happens is yet to be seen. But I agree with you. It's really going to be based on inflation more than anything.
Yeah, this is all about inflation.
Yeah.
This is definitely all about inflation. And if we can get to, let's go back to that slide. If we can get back to a point where inflation starts a pretty steep decline into 2023, markets will be cheering that. Of course, that remains to be seen, but that's really what we're hoping for. So when we model inflation, we model it. These are simple models based on different scenarios of 4% run rate, 3% run rate, 2% run rate. And we don't have actually, in our very simple model, which actually lines up by coincident, very close to consensus. When we look at our model, we don't have inflation falling a heck of a lot into over the next 2 months. But beyond that, it does seem like inflation starts heading lower pretty quickly. So we do expect inflation to fall pretty quickly in 2023. Now, what could go wrong? Inflation could be stickier than we expect or we model, and that's an issue. You do have a Democratic Congress and president, so they're all for fiscal stimulus. You can get that. We could get another supply side shock, an energy shock, or something of that nature. Those are all things that could upset the apple cart. But based on prior baselines, and you're probably right. I should probably put 1979 in there. But based on prior baselines, we're really trending according to the historical average. So hopefully it continues, and we see a sharp decrease in inflation in coming months. The interesting thing is that Fed funds rate is what is it, 3.25%, right? But the 2-year yield is something like 4.2%.
Exactly, that's crazy.
So the market's already priced in future Fed funds rate hikes.
You're telling me you get a two-year yield, and they're going to pay you 4%.
Mm-hmm.
I mean, if you would have told me that 2 years ago, I'd ask you to pee in a cup. Okay. I mean, think about that, because the 10-year Treasury got, like 2 years ago, was around 0.6%, and now the 2-year note is paying 4%.
A year ago, I think the yield on the 2-year Treasury was 0.3.
Yeah.
So you basically got nothing, and now you're getting a lot. So
what is the risk? Let's say an investor buys that 2-year note and it's paying 4%. What's the risk? The Fed rates? Not a lot, right?
Well, I mean, it's an opportunity cost. I mean, it's not really okay, let's say a year out, he has to sell the paper, and the yield on that paper went from 4 to 5%. Or something crazy like this, and even that's really dubious, because nobody really expects the Fed to really keep rates super high for that long. Anyway, you'll be selling the paper at a loss, a small loss, So there's not a lot of risk, in my opinion, but there's always risk when you're dealing with financial assets. Mind you, if you're willing to hold that paper to maturity, that's your yield. You're going to get 4% and 4% yield this year and next year.
So the difference will be is, what did you buy it at? And obviously, if rates spike, what you bought it at is going to be less. So you have to factor that in as well. So the question then becomes, how much less would it be another rate hike or two?
Yeah, that's right. Yeah. So the way I would think about it is, if I buy it now, I can make 4.2% or whatever it is. If I buy it in February, maybe I make 4.5%. Maybe not, though. So it's an opportunity cost. I can make 4.2% now, or I might be able to get more later. But there's no guarantee that you're going to get more later. That's like, these are risk assets we're dealing with.
I mean, the reality also is there is speculation, because Colin Powell has to talk tough right now, right? He has to talk tough. But if things do change and the economy does start, because right now the economy's strong, right? The wage market is strong, right?
Yeah.
But if that changes next year, and we do see some of the recession fears come to fruition, he's going to have to slow his roll down, and that's going to affect things as well, correct?
Yeah, I think you're dead on the money there. It's easy to talk tough when the labor market's super strong, inflation's high, and the economy is humming along. It's harder to talk tough when the economy's stumbling, the unemployment rate's rising, and inflation's falling. You would expect a different message from the Fed then. And that's been his way too. Not to knock Chairman Powell too much, but in 2018, he fully intended to raise the Fed funds rate and keep it up because he wanted to have like dry powder in case something happened. And then, of course, the economy stumbled, markets crashed, and in 2019, he reversed course. So it's not like he hasn't done before.
And then the
Anyway,
pandemic came in 2020, and that just, I have felt even before the pandemic that rates were held artificially low because they were afraid of stumbling the economy, right? They were afraid
mhm.
of stopping the growth somehow.
Yeah, yeah, and uh, I think that's part of the problem. You know, the Fed's been far too activist for over a decade. I think it really needs to find that market level of a rate of interest and just leave and just try to leave it there as much as conditions allow. I mean, the market rate of interest or the so-called neutral rate of interest, it's always changing. So, but you know, that's the ideal, isn't it? It is to have that market neutral rate of interest be kind of like the base. Anyway, do you mind if I share my screen?
Please do, because I think what a lot of listeners are curious or interested in is because rates have gone high, now fixed accounts, fixed rates, and even bonds are becoming more attractive for those who are kind of on the fence, sitting on cash, don't want to take the potential 20% further market correction because I don't think the world's coming to an end, but I certainly don't believe we've hit bottom as of yet. And I know maybe a tenth of what you know from a macro standpoint. So by all means, you see opportunities in this current market with the way rates are, don't you?
Yeah, yeah. You're right. This has been a very interest rate sensitive market. So as interest rates have risen, stock markets have declined, but so have fixed income markets. And is the Fed finished hiking rates? No, it's not. But if you're an investor that's committed to holding, an investment for, I don't know, 4 years, 5 years, you can lock in a yield that, to me, that strikes me as attractive. And I think over the medium term, that is over, say, 12 months or longer, some of those rising risks or rate risks are mitigated because what happens is when inflation declines, when economic growth slows, which is generally the outlook everybody has, yields tend to fall. They've always fallen. They've always fallen when inflation declines and growth slows. That's general overall macro tendency as far as treasury yields. But let's just get into our presentation.
And on that point, I just want to add, because of monetary policy, people are spending less, which will affect corporate profits, will affect the rates, because if they're borrowing less. But yes, please. You're starting off here with the income opportunities, and the key issue is indeed inflation.
Correct. This is all about inflation, 100%. If we didn't have an inflation problem, the Fed wouldn't be hiking as aggressively as it is. If we didn't have the Fed hiking rates aggressively, we wouldn't be concerned about economic growth and so forth. So the Fed's preferred measure of inflation is something called the core PCE price index. It's akin to the core CPI index. So the CPI is what we think of when we think of inflation. And then they have this core measure that strips out volatile food and energy, while the core PCE index is akin to the core CPI index. It also strips out food and energy. And so the Fed sees this as a more complete measure of inflationary trends. What I did is I calculated the 3-month annualized rate, and you see that short-term inflation momentum is basically on the decline. And so the momentum behind PCE inflation, the Fed's favorite policy measure, it's weakening pretty quickly. So that's interesting.
It's hard because people, the last they noted was 8.3%, which was essentially flat from the month before.
Yeah.
Because look, 8% inflation is that's not great. but
No.
I'm glad that it's not spiking. It's not 8.5 to 9%. So you're saying to all the listeners out there that according to your analysis, it's actually cooling off the inflation in the last 3 months.
Yes. Yeah. The momentum behind inflation is absolutely cooling off. Inflation never goes down in a straight line, and that's not happening this time either. So the issue last time was month-to-month inflation actually ticked up 0.6%, and there's just noise in the price numbers, and that's what you see. And of course, everybody freaked out about it. But when you look at the 3-month annualized rate, you're actually seeing a decline in inflation momentum. So here's another indicator.
I think the reason I think people are freaking out is because as soon as like last year, inflation was still around 2%. So how did we go from 2 to 8? It didn't happen overnight. It seemed to have gradually kept picking up momentum part of last year and going into the beginning of this year.
Yeah, momentum is a key word there. So you recall about a year ago, we had all those stories of container ships, backed up in the offshore, off the coast of Long Beach and LA, the ports of Long Beach and LA. They couldn't get their cargoes in, and there were supply chain backlogs where various parts of the manufacturing supply chain couldn't get parts to complete even their intermediate goods, let alone finished goods. So, those stories seem to have been falling by the wayside. We don't hear about supply chain pressures much anymore. It's still elevated. This is a New York Fed supply chain pressure index. It's basically trying to measure supply chain bottlenecks. And you can see, this is to August, and you can see how quickly the supply chain pressures have fallen. Now, they're still high, but they're not nearly as high as they were, say, a year ago. And they're falling quickly. So, supply-driven factors will help pull overall inflation lower. But there's inertia, right? And we've seen that. There's a lot of inertia with inflation. And even though those stories started coming out in the fall of 2021 and into spring of 2022, pardon me, you still saw inflation rise through to June, peak out in June at 9.1% before it started falling. So
that's what I'm saying. Yes, within this year particularly, it seemed like inflation was on steroids. Because I think most of last year was still somewhere around 2% officially.
2.5%. Yeah, something like that.
In the twos. So now that I never thought that we would say, wow, what a breath of relief. We're only at 8.3% in inflation when it was down for so long. I think part of the problem was some of the bills that they passed and all the stimulus that they were putting out there because of COVID. And that certainly didn't help the inflation part.
Yeah, you're correct. Yeah, there was a demand side to it. So you had, because of COVID lockdowns and even the period where we're coming out of lockdowns, you had the economy producing less than it had in the past. At the same time, we were pumping, trillions of dollars of fiscal stimulus into it. Of course, it's going to have an inflationary impact. But the good news is that fiscal stimulus is wearing off. There's very little of it in the economy. There is some, but there's very little of it relative to what we saw even a year
because
ago.
People have spent it already.
That's right. Yeah.
That's what it is.
I actually know a family that pooled their money together and went out and bought a boat. So they pooled their fiscal stimulus checks together, went out and bought a boat. Anyway, okay. So obviously, like we said earlier, avoid high yields at any cost. It doesn't matter if it looks like a great bargain. It's not going to help you out at this point in the credit cycle or the business cycle. So just looking at Fidelity data for bond yields this morning. So we have yields 1 through 30 years, U.S. Treasury, agency, corporates, munis, and then tax equivalent yields on these munis. So as far as investment positioning, if you're looking just to lock in a yield for a few years, we think there's opportunities. So number one, it's important to note that bond yields actually tend to fall when inflation falls and when economic growth falls. I think we said that earlier. So that mitigates some of the interest rate risk, we think. The second is we would favor, of course, high quality bonds. So US Treasury bonds, high quality investment corporates, and municipal bonds if you're a taxable investor. We think that investment grade bonds will mitigate some of the spread widening because balance sheets are so much stronger now than they were, say, even 10 years ago. After the financial crisis, a lot of corporate treasury departments, they learned their lesson. And even how the capital stack, as they call it, like the term structure of the corporate debt is termed out, mitigates risk to the investor. There's not a lot of companies that are going to have to refinance like half their debt in the next year. That they've just been a lot smarter about how they manage their balance sheets than they were a decade ago. And we think, just looking at the table, we think there's good opportunities here just based on notional yield. Assuming you're going to hold to maturity, you would get a 5% annualized yield. Every year you earn 5% by owning a 5-year agency. And we would avoid the AAA just because we don't think yields are high enough. But for AA, single A, and if you're if you stomach the risk, the triple Bs, we see yields between 5 and 7%, 4 to 5. So these are. Let's assume you're buying that 4-year triple B bond. You would be earning a 7.4% before fees, 7.4% annual return till maturity for the next 4 years. You'd be earning that. The other thing we like is munis. 3.28% doesn't seem like a lot, but if we adjust that for, say, a 35% federal tax rate, that's actually an equivalent on a taxable basis. That's actually equivalent of earning 5% per year for the next 4 years. If we go to single A munis, that 4.1% is like earning 6.3%. I mean, the municipal bonds for taxable investors, municipal bonds are very attractive right now.
Peter, because of the yields, are we able to buy those below par right now? And even though they'll mature at par in 5 years?
Some of them, it depends, right? So let's say the benchmark rate of interest is 4%. So if the coupon on that bond is 7%, so it's higher than the benchmark rate of interest, in order to bid it down to that benchmark rate of interest, you'll have to pay a premium. If it's below 4%, if the coupon on the bond, the stated interest rate on the bond is below 4%, then you can buy it at a discount. So it's really a function of two things: where benchmark rates are, interest rates are, and how big the coupon is. So let's take this AA corporate. It's 5%. So the benchmark rate of interest is 5%. If we have a bond that has a 7% coupon, you would still pay a premium for that bond. So it doesn't mean you're not making 5%. It just means you're making 5% over the life of the bond. Your annualized yield, assuming you amortize your premium that you paid, which is an accounting artifact, I know, but you're essentially making 5% every year for the next 5 years, even though it's got a 7% coupon, because you have to pay a premium. Does that make sense?
Sure.
Okay, perfect. And I think that's kind of it. But we have this disclosure slide that tells the world that these are my opinions and not independent solutions. And
that's right. If you want to sue anybody for misinformation, it's Peter Nielsen and Paul Meeks, ladies and gentlemen, not Danny Arcacci.
Yeah. Oh, yeah. Well, actually, I forgot to take Paul's name off there.
Paul's going to love that you kept his name on that. I think here's the thing. This is all good technical stuff to know, but I think most investors are scratching their heads. They're looking for cover. They don't know quite. You have the recession fears. You have the stock market, correcting even further fears. And I think investors are looking, perhaps you can never time the market. And I try and tell them, if you're in the equity market, you better have at least a 10-year horizon. Otherwise, you probably should not be in the equities market. Because at any given decade, we typically have a couple of years that are down. How far down you are is how well you're allocated on your risk tolerance you had. You don't see, going to next year that that we're going to remain in the state that we are now. And hope God, I hope that's true, because if inflation is not under check, we are going to hit the brakes hard. We are going to see a recession and all kinds of bad things, which people forget. We've had such a long bull market. This is typically a natural progression of everything. We can't always have up years.
You just don't usually see the Fed as aggressive as it is. So, like, as you're probably aware, the Fed policy hits the economy with a lag, and so they've pushed through big rate hike after big rate hike without really assessing what its impact is.
The long-term impact.
Yes. Yeah. Like it's really hard, right? So you're the chairman of the Federal Reserve, and you get your economists to forecast what financial conditions in the economy looks like 12 months out, absent any policy decision from you. And then you start thinking about, well, what if we do this? What do things look like 12 months out? The problem right now, Denny, is the Fed seems a little backward looking. They're really mostly just concerned about what inflation is doing today, rather than what financial ramifications are 12 months out.
Probably, Peter, it's probably because it seems overnight we went from 2.5 to where we are.
Yeah.
Not in a long period of time. We're talking a year.
That's exactly it, right?
And I see it when I go to the grocery store.
Mm-hmm.
The package that cost me $5 a year ago is $11 now.
Yeah.
That is, they can tell me what the rate is all day that they want on a CPI index. But when I go buy things, and that's not just groceries, it's anything you buy, including cars, that's where consumers are seeing a huge hit. And they're just wondering if it's going to continue. So you say that there's been very few times that the Fed's been this aggressive. Truly.
I can't even cite a single incident where it's been this aggressive. So even during Volcker's time, he didn't hike rates this fast. Like the percentage change in rates didn't hike and increase this fast. So yeah, it's and when you hear him talk, it's all about we need confirmation that inflation is coming down. These guys have like the world's best economists under one roof. And some of that data I showed you, like that supply chain backlog index, that was a New York Fed that put that together. A lot of their indicators that I use are Federal Reserve indicators, and like everything is pointing to lower inflation. That's what it's pointing to. And yet here, all they're talking about is what inflation is doing today. I have a real problem with that. I don't like being a critic of the Fed because I think a lot of criticisms are misguided. But like this Fed right now, like it just seems cavalier. And
well, you mentioned the supply chain issue. They're not talking about it anymore. I can remember about a year ago, it was a serious problem. We had boats and docks. It was a pileup. They couldn't get stuff. So that has been resolved for the most part now?
For the most part, it's still an issue, but
because that, of course, is going to make prices go through the roof.
Yeah. So Ford came out and said, we couldn't manufacture as many cars as we wanted because we didn't have parts. Anyway, when they were pressed, it turned out that one of the parts they didn't have were the little oval badges that said Ford on them. They didn't have enough, those Ford emblems to stick on the cars. I mean, look,
That's a
there's
good
still,
reason to hold up production. I mean,
well, you don't want to pump out cars that don't have your name on them, right? But yeah, yeah, it just seems like the Fed. You're right. The supply chain issues are getting better week by week by week. They're still out there, but they're getting better all the time. Are there things that can happen? Like, I guess China could invade Taiwan. Like, I don't
yeah,
know.
this war in Ukraine could escalate even
Yeah,
further.
yeah. Like they
There
could
are
use
some,
nukes, and then what happens?
but in the grand scheme of things, again, if you look at the fact that we had one of the greatest bull markets, it's not totally out of line that we have a corrective year or two, because nothing goes straight up. I don't know necessarily that we're in a bubble right now like we had in 2008 or we had in 2000,
Mhm.
but I mean, nothing can keep going straight up. The economy has to slow up eventually. Growth, and I think the monetary policy has caused people to spend less, which I never got how spending money frivolously was great for the economy.
Mhm.
Where people go into debt and they
Yeah.
mortgage their house and oh, that's great, and money's flowing. So people are spending less. They're being more frugal, as well as they should be, and things are slowing down. Now, do we stay this way? I don't think so. I mean, inflation can't keep rearing its
Yeah.
ugly head forever.
Well, you know what's not talked about is, even if inflation drops to zero tomorrow, like it goes from 8% to zero, and it stays at zero for like the next 5-10 years, you're still seeing an American consumer that has had their standard of living, I wouldn't say permanently impaired, but impaired for years. It'll take years of income growth above the rate of inflation to allow the average American to have the same standard of living he had before this all started. People really took it on the chin. And I mean, some people are more susceptible to inflation than others. Like, I work from home, so my inflation rate's probably lower than yours, because I don't burn up a lot of fuel every day going to and fro. I shop for groceries twice a week, and I play golf once a week. My inflation rate's pretty low. But somebody who's got a long commute, whose wife shops at the grocery store for a large family and so forth, their inflation rate is probably not 8%. Their inflation rate is probably 15%.
Absolutely. Absolutely.
So it's people have really taken a long-term hit to their standard of living, and it will take years to recover. Yeah.
And it happened so quickly, Peter.
It did, and nobody talks about it. Political, kings that they don't want to talk about inflation too much because it makes them uncomfortable. It's not very, politically expedient. But honestly, a real leader would say, "Yeah, this is horrible, and we're going to try to set up a situation where we can help America recover from this. It's going to take some time." That would be real leadership.
I think the middle class is the one that's taking it on the chin, like you're saying, and you are spot on there. I wish they would talk more about. I think, unfortunately, inflation is being played off right now. Like, hey, it's not a big deal, it's been about the same. But I think you're right. It's going to take the average family years to recuperate from this and realize that their standard of living has been compromised.
Yeah.
I think the ultra wealthy or the ultra poor, not really going to affect them as much. It's the middle class. Like you say, the family that has to buy the groceries for the large family, the ones who have to commute, the cost of gas, the cost of consumer goods.
Mm-hmm.
That's who it's going to affect most, the middle class.
Yeah. And that's a real tragedy. I know they're spending money now on vacations and travel and stuff like that, but let's see what that looks like 2 years out.
Yeah, I don't. I haven't gone on a vacation in a while, so I don't know.
Well, Memphis, you're going to Memphis.
That's not a vacation. That's to compete. I'm going to be working and seeing about, competing and doing something musically. But It's always good to talk about it, and I want to edit this for the consumers and have it on the podcast.
Okay.
Always great talking to you, my friend. And
Yeah. I'm glad I could help. And anyway, good luck with I was thinking, as much as you're considering it work and so forth, like you have to haul your equipment and so forth, and you're your own roadie. You don't have roadies, right? So hauling the drums and amps and all that, that's kind of a hassle. But I don't know. You're still on stage. You're still doing what you love.
I know I'm not asking someone to do something that's in their best interest and watch them procrastinate and chase them down. Yes, you're right. It's not the same. So
did I ever tell you I was in a band way back when I had hair down to my collar when I had hair, and I played bass, and our drummer had visions of grandeur. We were just like your average band, right? And we'd learn like 3-4 songs and learn them super well and play them. And that's what we would do. And anyway, so the drummer who had these visions of stardom, he got us a gig at something. This is in Vancouver, BC, at something called the African Caribbean Festival. I'd never heard of it. So I asked him. I said, "Where is it?" It's in Oppenheimer Park. Well, Oppenheimer Park is this big park that's kind of out of the way a little ways, in East Vancouver. A little poor area town. Anyway, so I said, "Okay." So I figured a couple hundred people. We'd play our songs and then we'd leave. Anyway, there was like 10,000 people there. and the stage was there was speaker stacks, massive speaker stacks on either side of the stage, and we got up there, played our songs. I can tell you, Denny, I was so nervous my fingers were hardly work. We sucked.
Well, hey, I think we should revisit this by the next quarter. Always love to talk to you and Paul Meeks and everyone at Independent Solutions. You have a great team, lots of experience. No one has a crystal ball. We try and work for our clients with good batting averages and never try and predict the top or the bottom of any particular market. And I think it really is a good time for investors to consider maybe some of these fixed income strategies to be part of their portfolio. I wouldn't say give up everything you're doing, but I think there's a lot of people sitting on cash right now that could take advantage of some of these yields. And I know people are waiting for the world to come to an end or a steep bottom, and then they're going to step in and buy. But I like what you said earlier, that you wouldn't maybe buy everything now. You piecemeal it, buy a little bit this quarter, a little bit next quarter, get a good cost average involved. And to all the regular consumers, remember the market is trading for what it anticipates next year, not next month. I know it gets all the headlines, but markets typically trade for next year and beyond.
Yeah, markets are anticipatory. They're looking ahead.
Yeah. They're not looking for the next 2 months.
And that's the interesting thing. If you look at the market's estimate for the bond market's estimate for what inflation is going to do, the bond market's pricing in about 2.3% inflation. So, I think that's important to point out is the market itself is pricing in lower inflation. It doesn't mean the market's correct, but it certainly gives credibility to some of the forecasts we're seeing out there.
And if they're wrong, obviously bond portfolios will suffer greatly, because the longer you go out, the principals will be hit hard. If they're factoring in only 2.5% and inflation stays above 6 or 7%, that's a bet that's going to cost them.
Mm-hmm. Yeah, that's right. If we get inflation wrong, it upends a lot of things. So that's a risk. But like I say, the bond market itself is forecasting lower inflation, as are consensus, the economists from big global institutions. So we take some heart in that.
Great. So, hey, maybe happy days we'll be here again soon. Always a pleasure, Peter Nielsen.
Thank you.
And how's the guitar playing coming along?
Oh, learn how to play a very nice arrangement of Georgia on My Mind by a nice Swedish composer.
Yeah.
And just it really captures the bluesy elements of Hoagie Carmichael's original. I love it.
See, people don't know that you and Paul Meeks are into music, like I am. And matter of fact, I'm getting ready to compete again to go back to Memphis. This coming Sunday is a competition. I hope I do well, but it's good. It can't just be all about numbers and dollars and cents.
No.
You'd go crazy.
Yeah, there's a beautiful life to be lived. Right?
Yes, there is. Always a pleasure, Peter Nielsen. I'll see you next time, and let's see what it looks like in next quarter. Okay.
Yeah, sounds like a great idea.
All right. Have a good one, my friend.
Well, I hope you got something out of it. And of course, if you'd like to know more, the office line is 561-537-5897. 561-537-5897. So it's a great time to get with your professional. Look at what you're doing. Diversify not only in different sectors, but also different buffered strategies, or having some of these fixed indexed or fixed accounts in your portfolio, so you can at least make something on your money while we weather the storms. I don't think that the world's coming to an end, as I've said it, but I'm not quite sure that we've hit the bottom yet. So for those investing for the long term, there's going to be some good buying opportunities as long as you can, stomach the ebbs and flows of the market. As always, thanks for listening to Denny Artachi Show, and make it a great day. And I hope to get back with you soon. Thanks.